Yo, what's up you guys? Welcome back to another video. Today we're gonna take a look at the market from both a technical and a fundamental perspective and just give you guys my overview for the market for this week. So without any further ado, let's get straight to it. Two things I want to speak about before we get over to the news events that's taking place this week is we had the interest rate decision by the Feds that came through. Was kept stable at 5.5%. Sorry, 5.50. It was just kept as normal. And then the NFP, the unemployment rate, was also kept stable at 3.7. There was an increase in jobs, not only beating the Dow Jones' expectations, but it also came through higher than the previous month. The average hourly earnings also increased by 0.6%, up from 0.4%. Now let's talk about this very quickly, right? So how does the interest rate tie in with the unemployment data? So remember that when the Feds hike the interest rate, right? When interest rates are hiked, this puts constraint on consumers, which is why you'll see that consumer, the CPI, which is an indicator used to measure inflation, it's called the consumer spending index. When interest rate increases, this puts pressure on consumers. So by definition, the consumer spending index, which is the CPI, tend to take a dip. Why? Because consumers doesn't have money to spend due to the higher interest rate that they need to pay on their debt, right? Car, homes, and all of that stuff. But because of higher interest rates, that means the dollar index will increase in value because investors tend to invest their money in currencies that's got a high return on their investment. So higher interest for investor means that they will get a bigger return. The problem for the consumer is that their debt will increase because the bank passes that increase from the central bank onto the local bank. The local bank then passes that increase onto the consumer, and their debt increases. Now, how does this tie in with the NFP? That's very simple. So when Feds increase the interest rate, consumers spend less. Now, if you look at the NASDAQ composite, the NASDAQ consists of 100 of the top tech companies around the world, firstly, and these companies all have one thing in common. They're all tech companies, and these companies sell things like iPhones. Amazon sell all kinds of stuff that you can get. You've got Facebook. You basically have Tesla on there as well. Now, when consumers cannot spend, that means these companies, they do not make as much money as they would where consumer spendings are high. But consumers can't spend. Why? Because interest rates are high, and that is affecting their pocket to spend. So when consumers can't spend, companies can't make money. And you know what happens when companies can't make money? You tend to expect layoffs and people losing their jobs. That is why I don't normally focus on this. I always look at the unemployment rate, and we can see that the unemployment rate has been kept stable at 3.7%, just like the interest rate has been kept stable at 5.5% as well. Now, next week we do have more high impact news. We've got the PMI on Monday, and then on Tuesday we've got nothing. Wednesday we've got the US trade balance, and then we have on on Thursday we've got the jobless claims and the wholesale sales month over month. I'm just confused with the layout here. And then on Friday, we don't have anything as well. So again, like I've said in the breakdown that I did before, if the Feds does hike the interest rate or keep it at a stable, there's a high possibility that the dollar index will increase in value. And this is exactly what we see over here. The market had now broken out of this very important structure that it has been trading in. Acted as support there, resistance, market consolidated. We had a breakout. I do expect a higher move to the upside. I do expect this market to continue higher there first, then pull back, and then potentially continue higher as well. As this level over here acted as a level of resistance, the market broke above resistance. All of that resistance is now turned support as well. The next level of structure that we have to take into consideration is going to be this level over here, because that is a level of resistance as well. Next up, we do have the NASDAQ. Now, the NASDAQ still has not been able to break out. So I would say that because of the negative correlation between the index and the NASDAQ, I do expect the NASDAQ to pull back this week. We could potentially see the market complete this inverse head and shoulders pattern over here, which is considered a bullish pattern from a technical perspective. But I would expect the market to continue lower based off where it is now, because we had support over here. The market broke below support, came back, tested it as resistance, broken above resistance, now testing the previous resistance. A pullback is expected in this market. So for now, I'll give you guys another update. I would anticipate this market to just pull back till there, and then from there we could potentially see an inverted head and shoulders pattern, or we could potentially break below support, test it as resistance, and then continuing lower as well. Next up, we do have the Dow Jones. So the Dow Jones over here had broken above structure. You can see the candle closed. We've also been trading very like, this is so beautiful, right? You know, regardless of this market being so heavily overextended to the upside, you can see our price action has once again just proven us why we should not be paying anybody to give us a signal, right? Because you can see our beautiful price action. Beautiful resistance, support, resistance, broke support, all of that stuff is taking place there. So I would say just be careful here, because as much as you should be buying in a bullish trend, and I agree with that statement, because I know I made it with CJ Bankroll because he was buying. He actually sent me a message on Twitter. I think that's why I've been stuck playing GTA San Andreas so much. I'm playing GTA San Andreas, you know, since this morning, and now throughout load shedding as well. But like I said to him as well, it is not ideal to always buy in a bullish market. Well, it is ideal, but for me personally, I would be very careful just looking for buys this high up. But it is good to look for buys when you are in bullish territory. Bullish territory refers to trading above structure. You're trading above structure. You understand? As long as you're trading above a structure, by all means. The minute, if this candle was here below structure, I would not be looking for buys until we got above that structure. And that is the easy thing to understand about this. For the Dow Jones, I would say, you know what, we could potentially see this market move higher, but I would wait for price action to just develop a little bit further before looking for any buying opportunities. Because if you do take the Fibonacci over here, from the low to the high, we had a pullback to the 0.50%, which is a 50% pullback of that move. And if we readjust the Fibonacci just to get there, you can see that we did hit the target level for the Dow Jones. So again, we could go higher, we could go lower. I would just monitor the price over there. Now, gold over here just printed what's known as a W formation to the neckline. Right now, this normally works out, and sometimes it doesn't work out. At the moment, gold is negatively correlated with the index. So when the price of the dollar index increases in value, you tend to expect gold to decrease in value. Although this is bullish territory, like I said before, we are trading above structure. If we do expect the dollar index to increase in value, then we need to wait for a dip below this level in order to sell gold. And doing so, will the market print what's known as a head and shoulders pattern, which is considered a bullish a bearish pattern from a technical perspective. Alternatively, this market can also just continue higher, but based off my own outlook for the market, I would probably say that I would be bearish on this market, purely because I expect the dollar index to increase in value. But the only time I will be bearish on here is if we break below structure. As long as we're above structure, I might potentially be looking for short-term buys, but not any long-term buys. Next up, we have got the German 30 index. This market clearly did not break above structure, and you can see here once again we are trading in strong bullish territory. We are trading above structure. So by all means, again, this could be the start of a consolidation. We have a resistance, support. So I would say for now, I'll probably expect this market to pull back. And then from there, I'll just monitor the price action, give you guys another update if there is anything related to the index. That is it from my side, guys. And please remember, I don't review EAs because they are too expensive. I'm not going to pay 15,000 for an EA with what's his name, I can't pronounce that. The guy with the Lamborghini Urus, that you know, only for not to work out. Okay, so as the channel grows, then by all means, the budget will grow. But I've just started with this series, and you guys are already demanding high rollers. Like, what's this? You know, like I always said, my threshold is 500. I can't go above that, right? If I do go above that, that's probably someone who had inboxed me and said, you know what, we're willing to pay whatever difference there is. But if you're not going to pay the difference, then just wait until I release the next video. And the video will always be related to what people are asking for. But if you're going to ask me for someone who's going to charge me 1,600, you know, or 800 or 900 or 1,000, then you're going to have to wait until there's a budget for that, right? Thank you for your time. And as always, cheers for years.